Hey, everybody. Welcome. Thanks for coming to this fundraising panel. We're happy to chat with you. My name's Josh from Blizzard, the Avalanche Fund, and we're joined by, for this panel, by Brandon from Framework, Mark from Avalaunch, and Steven from GoGo Pool. And really want to make this this panel in the spirit of the Creates event about your questions and about answering those. Much more than just hearing from us. So we'll spend the majority of the time trying to answer some of your questions, though I've seeded some of this with common questions that I've already received over the past day or so, and some questions that we'd love to help answer. I guess first, both Brandon and Mark are investors in Steven's GoGo Pool, and wanted to ask about your experiences raising a recent $5 million round. Tell us how that went.
Yeah, thanks. So, yeah, my name's Steven, co-founder of GoGo Pool. The fundraise itself was pretty good. It was kind of lightning in a bottle, but definitely very intentional. Whereas kind of a funky timing right in the middle, where we started the fundraise during the tail end, like maybe 4 weeks before the Luna crash. And then we closed the fundraise maybe a week or two after the crash. So there's like 5 days in the middle there. They're very touch and go. But no, it was good. And then I think, like, Mark, you were my very first conversation, like even when I was new to the ecosystem in like January, maybe like late December or something. And then the Avalaunch guys were awesome, so I knew in some way, shape, or form I want to work with them. And then was connected to Framework maybe halfway through the round, or maybe towards the second half for sure of the round. And yeah, happy to work with both of them. Happy to get into any specifics about the fundraise.
We'll move to some other questions, but keep that in mind for future questions about this recent experience. He's happy to take more questions there. Brandon, what do you expect in a pitch? What do you want to hear out of a pitch when you first meet with an entrepreneur?
Yeah, sure. Well, hi, everyone. My name is Brandon. I think, there's plenty of templates online and tweets about content that should be in your pitch, like everything from problem statement, solution, team, et cetera, but more importantly, in my opinion, is just the level of depth. Oh, excuse me. The level of depth and, frankly, preparation from the founder or the founding team speaks volumes. I think, frankly, in crypto, there are no bad ideas. There is bad timing. And so to the extent that you can illuminate your thoughts around, okay, here's how we're starting, here's sort of our niche, here's how we're doing go-to-market, here's our technological moat. There's really any number of avenues that I think are distinct to the founder, to the founding team. And really, the job of a pitch, or the North Star of any pitch, is to highlight those things and really stand out in any way that you can. The other thing too, which broadly correlated to this question, is just I want to know how self-aware a founder is, and I want to know your absolute strengths, what you're gonna bulldoze like maybe competitors on, for example, but also just being cognizant of your weak points. Do you need a biz dev person, an ops person, help on recruiting? Like, do you want to be like the classic Silicon Valley archetype of I'm a solo tech founder and everything else is kind of like second priority? I think early on in crypto, that was definitely the narrative. We're certainly seeing that change as the space matures, and we've certainly seen that play out in other industries as well, where you frankly want to have a diverse cast of characters around the table and a full opinion. I like distinct opinions, formally founded from facts. So I'm kind of rambling at this point, but generally I'd boil it down to preparation and just, having a clear train of thought as to what it is that you're going to be committing yourself to for at least the next 5 years. That's a major, commitment not to be taken lightly.
Steven, when we were speaking a little earlier, you mentioned that some of your initial pitches did not have slides. What did you still cover those same areas, or do you think you got to the things that Brandon was speaking about?
Yeah, 100%. It's like take everything what Brandon just said, and then we just kind of, I really focused on doing it our own way. So I knew from previous startups, fundraising in previous environments, As soon as you whip out a pitch deck or send something earlier, it's like now it starts feeling more transactional. But so I spent like 2 or 3 years kind of growing and like my training as a dev, but spent 2 or 3 years growing and scaling out a sales team, ranging from really small price points to really high price points. And the VC sale, I treated it just like an enterprise sale. So in the first call in an enterprise sale, it's all about discovery, learn about them, what do they want, what do they need, what problems are they running into, et cetera, et cetera. So I mean, I always had a couple really kind of like key qualifying questions to go into, and then that kind of transitions naturally into they also have their own qualifying questions. So there's no, for me personally, I feel like there's no real need for me to stress out over a pitch deck, just because, I mean, I did stress out over the pitch and the framework of the pitch, like spend many, many hours just kind of like fine tuning that thing, get that sucker super optimized. But yeah, for a pitch deck, I just think that it kind of goes more transactional, but if you can still show off your preparation and kind of like thinking on the spot. And I think what a lot of people miss when they're fundraising is not asking the investors, like really trying to get to know like Mark and Brandon, like I really try to get to know them as people. I mean, to the extent that's possible in like the short amount of time you have. But yeah, at the end of the day, it's just another sales meeting, another professional call, and just kind of go for it.
Mark, what does it mean to find the right investor? Steve was just talking about those developing the relationship, but tell us what that means to you about finding the right investor and the right relationship.
Yeah, sure. I actually have a whole talk tomorrow about this very topic, and I think the thrust of it is at this point, a little less so now, but still true. Money's pretty easy to come by in crypto, and a lot of times, crypto's strange. You can see $5 million funded off of no deck, and then you can see the best deck you've ever seen, and no one cares. So it's really interesting in that way. But finding the right investor is about really, it is really about creating that human relationship. It's the acknowledgement that you are going to be working with these people for several years. And so the mistake I think I see a lot of founders make is lose that concept completely. Is they do really think about it as the transaction, as the check is written and my job is done. And what they're not really thinking about is that your backers are a real opportunity to get the critical support that you need throughout the life of the project. And that comes from, again, a healthy human relationship. So when you're talking about finding the right investor, it's as a founder trying to connect and vet them as much as they are you. It's not as simple as did the dollars come in the door. It's is there a good culture fit? Do their values align with mine? Do I actually like working with these people? Because if you have good VCs, good backers, you're going to be working with them. So I think there needs to kind of be a conversation. At least some people understand it intuitively, but I do think there needs to be a conversation about kind of reframing what the founder-VC relation is, what the expectations around it should be, what as a founder you kind of deserve from your VCs, and at the end of the day, like they're part of the team, So it's about finding people that you feel fit into the fabric and the culture of what you're working on, and that also have the right resources and connections and opportunities that others don't, that are unique to what you need.
And to quickly piggyback onto that as well, one thing that surprised me during the fundraise is like, okay, I'm going in with this perspective, like human-based relationship, not super transactional. I would say maybe, at least in that time, 50% of the funds that I met with, they weren't looking for that. They're like, well, wait, where's the pitch deck? Okay, well, where's the value accrual? All right, great. Like, what's the valuation? What's the sizing of the check? Okay, we'll let you know in like towards the end, people were letting me know like 30 minutes. And I was like, whoa, like I've chatted with you for about 25 minutes here. So not all investors are necessarily looking for that. I mean, I think every single person that invested in our round was looking for that. So it's something we're pretty proud of. But something to keep in mind as well is like, it can feel different when you're actually boots on the ground.
Just, to tack on for a moment and put a wrapper on this, I think it's a really, really, key point. And it kind of boils back to the previous two comments, but also boiling it back into preparation. As a founder, kind of have a vision of your ideal cap table. Who are your partners? Sort of what is the composition? What is everyone bringing to the table in terms of value add? And, everyone ideally has, some unique form of this, but that does ultimately, I think, stem from your preparation of general just market mapping, understanding what it is that you need to be successful. And ultimately, to Steven's point, like the founders are in the driver's seat as it relates to who you want in, and you get to make the ultimate decision. So, and certainly, what we do at Framework and other funds do as well is like more than happy to be a sounding board there, help you construct the round, give feedback on sort of like inside baseball to who is value add. But ultimately, that starts at the founders level.
Steven, how important is it to have a lead investor and to work with them in terms of setting terms? Did you come out with, these are the terms we're raising at, or did you have to find others to help do that?
So my hot, spicy take here is it doesn't matter at all as long as your pipeline of investors is big enough. Because if you have enough people that just really want to get in the round, like you can pretty easily feel out like, all right, what's the valuation, what's the sizing, like what would work, what would work for this round. If you're only talking to 5 investors, then it's like, yeah, you should probably find someone good like a Framework or an Avalaunch and kind of like back into something with them. But yeah, frankly, when I was doing my fundraise, I was like, there's no way in hell I'm not going to raise funds, so let's nail it 100%. So I talked to a ton of funds. Yeah, so I guess, I don't know. For us, it wasn't that important. I just went in with something that I thought was pretty rational once I started feeling out how people were reacting to the idea. And then I just kind of picked my number and picked the round size. And then I was like, all right, let's make it work. And then just made sure I had enough conversation to generate kind of the hype and the echo chamber required to kind of like close out one of these rounds.
I'd play devil's advocate to that one.
For sure.
And I think it's especially relevant now. When times get tough, you want a Sherpa of the rounds. You're going to need to rely on somebody. And that's just a fact. We've seen it play out time and time again, not just in Web3, not just in crypto, in generally VC and tech investment. And so I would say, yeah, ultimately the world is your oyster in terms of, again, defining cap table and all these fun things. But you do want someone in your corner with meaningful skin in the game for times when things aren't going well. And, those times do come.
Yeah, I just really quickly add on to that because it goes back to what we were talking about before, and I do just think this is the biggest overarching theme, whether it's your lead investor or not. You want investors who, and you do gather this information as you meet with them and have conversations with them, and you kind of have to have a good sense of people and ask the right questions. But yeah, you want to make sure that you're confident that the people that are investing in you and backing you are going to be there during those tough times, because they will inevitably come. There's going to be markets like this where it's just really hard to traverse, and by the time you make a deal with them, you should feel comfortable or confident that when things go bad, because they will, whether it's the market or hack or something with your project or just the millions of things that are going to go wrong, these people are going to be here and they're going to be in your corner to guide you. You should feel really confident about that, because if you don't have that piece, I think you're missing something, unless you've been really clear that all you want from this investor is money. And if that's the case, then that's okay too. But if that's not the case, there's more to be had than that most of the time. You should be confident about that.
And give that a little flavor, and also totally agreeing with Brandon and Mark, is that that is as much of an emotional decision as a rational decision. So one of the first 3 questions I asked everyone in every first call is, what's your typical check size, and what type of allocation do you target to have over the next 4 years or whatever? Because then that gives you a sense of like, framework loves the leading rounds, right? It just doesn't make sense for the structure of their fund as a vehicle to do really small check sizes, right? Like, or really be underrepresented on the cap table, which usually doesn't make sense at the pre-seed seed, although I don't want to put words in your mouth. But it's like there are definitely funds like that. Like some funds want to lead and they need to hit a certain allocation, a certain check size. It's definitely good to be very upfront about that so they can kind of start playing with the pieces.
Brandon, tell us about the different types of investments, and in particular ones that you like to see, that you don't like to see, SAFE, SAFs, preferred equity, common equity. What does framework look for?
Sure. Well, I'd say the typical industry standard as of late is a SAFE plus a token warrant or some form of a side letter. I think kind of zooming out a bit more, though, is broadly speaking, it's unclear to us whether or not every single project, company, et cetera, needs a token. I mean, I think clearly the answer is no. But like historically, there were SAFs, there were OTC token deals, there was just all this sort of unique, let's say, vehicles. But the industry is clearly converging on SAFE plus token warrant. And I would say that, you know, the general gearing and a variable to consider as a founder is what's your equity valuation, assuming you have some form of a network with a token that accrues value or is, you know, useful in some maybe security manner, for example. Is the value of that network where value accrues? Does it accrue to the equity? And so just kind of having a clear roadmap as to what these vehicles represent for yourself and for your cap table. And of course, your investors will work with you on this, but yeah, there's generally, you know, variance between whether that's 1-to-1, the equity valuation accrues directly or correlates directly to the token. Maybe it's 1-to-2. There's all sorts of different sort of scales, but SAFE plus token warrant is certainly where we're operating. You go to other parts of the world, maybe they're still doing SAFs. Good luck, you know, with regulation here in the U.S. trying to do those, frankly. So SAFE plus token warrant would be, yeah, the take home.
And speaking of tokens, tokenomics, very important. And Mark, I know that you very much look at that tokenomics and help a lot of firms with that. Can you tell us just general thoughts on approach?
Yeah, sure. I mean, this is something we work, you know, closely with on basically all of the teams that we work with through the platform or otherwise. And tokenomics are a kind of a funny thing. They are very trend-based in some senses. You know, the way that people tended to design tokenomics 2 years ago looks very different than it does today. Part of that is a function of different types of applications being built with different needs, and part of it is that crypto is just really trendy. And this is what this guy's doing over here, so this is what I'm going to kind of do over here. But what we look at when we're looking at tokenomics is ultimately, you know, the appropriate balance and making sure that the right people are represented and the right incentives are there. And that can usually extend to what the project is and, you know, the utility of the token. But the tokenomics are where you can really mess a project up the worst, the earliest. And you write these and you decide on them, and then you put them into motion, and then your project's out in the wild, and it's just kind of math that's playing out, intersected with human psychology, and you're just kind of watching it. And so that's a really hard thing. And so having that conversation, trying to consider all the angles, not just for the health of the project, but things like, you know, optics, how this is going to be received by the community, by retail, making sure that your backers are served, but not at the expense of the project. it's a real mountain to climb, and every project has different needs. So it's real case by case, but ultimately we're looking for that balance that's going to lead to a healthy and sort of sustainable future for the project, and that just can look very, very different project to project.
The one thing I just wanted to add was generally for relevant to this audience in terms of expectation, especially in pre-seed and seed stage rounds, is your tokenomics are not going to be clearly defined, especially if you're pre-product. What is the token's purpose if we don't even have product live with data? And so that's generally, to boil back to why safe plus token warrant is the standard, is the safe gets everyone in the door, establishes the round, we're off to the races. And generally, a huge value add, like Framework, for example, we do this, but something to consider is who's going to help you design the token? Who has sort of the expertise in that realm? Who's seen all the models? What works, what doesn't, et cetera. And so, that's the reasoning behind Safe plus Token Warrant. It gives you the flexibility, gets someone in on your cap table to work with you on this. And ultimately, to Mark's point, you can only launch a token once, and you do not want to mess it up. So it's definitely not something to be rushed. And I wouldn't let, crypto, Twitter, or anyone pressure you into launching things quickly. That's especially on the token front where regulators are watching.
Great, thank you for that. So prepare your questions. I have sort of one more question, which I'll ask and answer myself, which I've heard a couple of times, is after a pitch, do I follow up with the investor? And the answer is absolutely yes. In general, we do not like to ghost people at all, even if it's a no decision. And we require follow-up, as just from our putting yourself in an investor's shoes, we will hear multiple pitches a day, multiple of that per week. And there's just a lot going on, as much as we use systems and other members from our team to keep track of everything that we've heard. And to remind ourselves to get back to you. Often you do need just a polite push, or often we need very much a polite push, which is fine, and you don't have to have a new development or some reason to reach out. Just a polite, hey, what are you thinking? Let's follow up is totally great. And Stephen, I think you had some experience there.
Yeah, for sure. So my experience was very much, I would just ask myself, what would the best salesperson do? And then just treating follow-ups like another part of the sales process, where typically if you're trying to break into an account or get to know someone in an enterprise to begin the sales case for them, there's a lot of follow-ups involved, right? I think there's some stat that's it was you probably remember it, but it was something like 10% of people respond to your first message, but by the fifth message, now you have a 60% response rate for the people that would have responded. And then after that, it's diminishing returns. So whenever I reach out to someone or we do a meeting or, it's time to schedule a next meeting, I kind of always implicitly assume there's going to be 2 or 3 nice follow-ups. That's how far I'm willing to go for this. But if it's time constrained, then it's time constrained and it's time to, back channel and get 10 people to tell them to respond to you at once. Because if someone's, But yeah, so that's kind of how we approached it. It's just kind of being super professional on the sales side, and, it's kind of part of the game.
Being cordial and kind just compounds. This isn't unique to pitching or raising money or any of this stuff, but it's worth reiterating.
Yeah, I would just say that in terms of that follow-up, you can talk to a lot of founders, and it's not uncommon to just get ghosted. And I don't think there's necessarily any reason for that. If you're not interested, I think the most logical sort of polite thing to do is sort of tell them why, and maybe there was things that you did like, but just be clear and concise, and and kind of close that loop. Avalaunch is in a bit of a different position that's a little unique, because we're specific to an ecosystem, and we want any project, whether we're going to work with them or invest in them, who's building on Avalanche, to feel like they have the support of the broader ecosystem. So we're kind of me and my co-founder David, who I do a lot of this work with, we're kind of like softies in this regard. We have trouble saying no. So we'll end up working for months with a project we have no intention of investing in, no intention of loss, because we feel bad. Like, we want them to have good information, we want them to feel welcome, we want them to feel heard. Like, we're just not bad people. It doesn't make you a bad person if you don't do that. But so we're like we're working on saying no instead of just getting this endless cycle of helping when maybe it would be better idea for someone else to help them. But that's an ecosystem thing more than a general VC sort of problem.
Okay, so we're happy to take questions from people in the room here. Just a reminder that this panel, this forum, is not the appropriate place to stand up and do your elevator pitch. That's later in the event or possibly tomorrow. But nonetheless, happy to answer questions based on our experience. And a microphone is coming around so we can people on video can hear as well. First up here.
I have a pretty specific question about DeFi projects and valuations during fundraising versus like comparable protocols that have, a live token and there's an existing market cap that you can look at. So specifically, I think there's a lot of like correlation we try to do between TVL revenue and then this valuation or market cap. So I'm just kind of curious if y'all have come into this when you're investing, if you've seen projects that are raising above what other comparable protocols existing floating market cap is. If you just have any thoughts on that in general.
I would say if you're raising a fresh, it's best not to over-index to some of these comps in the wild. They were likely done in a previous time that was more advantageous. Also, there's just a lot of nuance. Who holds the token? What's the application? What's the fidelity of this data around all of these metrics that you've just mentioned? And so I think zooming out, you want to back into how much capital do I realistically need? I'd say a typical range is like 15 to 20% dilution in like a seed stage round, for example. So that backs you into your valuation. And frankly, think of it that way. Like, a lot of founders, especially during this last bull run, were hyper optimized towards valuation. A lot of them are going to have tough times growing into that. And frankly, that puts them at a disadvantage. So I think just reprioritize towards what it is that you need to succeed. With almost, you don't want blinders on to comps, because you definitely want to be reasonable and want the most advantageous terms to yourself. But there is certainly flexibility, I would say, on comps.
And do you think there's certain types of TVL or certain types of revenue that will ultimately command a better market cap?
It's a good question. I think, again, nuance in terms of if it's cash, accrual to a token, what is the application, what's the sustainability of this volume? Was a lot of it retail NFT trading? Is there wash trading involved here? Where is the team based? Maybe the foundation's in the BVI, but is this a US-based company within the next 5 years in the eyes of regulators? Okay, is this then going to be a security? I think that broadly, we're still figuring all these things out as an industry as to which sort of accrual methods may be more meaningful than others. And so, I don't really have a concrete answer there. I would just say it broadly depends on what it is that we're analyzing.
I would also add that TVL in particular is something that's not necessarily a valuation metric, but it is a great performance metric about how a project is doing. So in terms of just looking at overall performance of a DeFi project, that's an important piece of performance, but it's not necessarily a direct plug into a formula about valuation.
Right. I guess my question, to be super specific, is a lending protocol with 50 million TVL versus a structured products protocol with 50 million TVL. Do you think it's easy to make the case that ultimately, assuming the market is pricing things efficiently, that the structured products protocol might have a higher market cap based on the general TVL number, or is that not even really a valid way to frame
Yeah, I think there are so many other factors that come into play when setting that. So it's not that direct. Go ahead.
I would say, echoing what he said, echoing what Brandon said, it's like there's nuance, and I would say like who has the better team, who can execute the best, and then in the context of fundraising, it's like how well, as the lead fundraiser, the CEO or whatever, how well can you explain that dynamic? Because if you're asking for a higher TVL or lower, like whatever, just like being able to put it in context for somebody else so that they can make an educated decision about your round specifically. That's kind of how I would think about it.
Yeah, and just to kind of wrap this up, I mean, like Brandon said, the comparables are useful for just kind of generally orienting. But if you're looking at one DeFi protocol compared to another, regardless of how similar or dissimilar they are, it's problematic, I think, to say, well, this protocol has 50 million in TVL, so we should naturally be able to achieve this kind of valuation. Because again, crypto is funny, and it isn't as efficient as what you're suggesting would imply. Not nearly so. So, there's things that can carry a project, and the valuation and the interest and the price that have nothing to do with the things that we're talking about right now. Narrative, story, hype. How long that lasts is kind of anyone's guess. But these are things that actually drive crypto in a lot of ways. So to Brandon's point earlier, it really is looking at your needs and kind of backing into them. Just because someone else did it doesn't mean it's a good idea. And again, it's very, very possibly a function of a different time that's passed. And the ways in which they've been able to sustain it and achieve it, that might not be possible for you, and it might not be as simple as numbers on paper. So, it's really, yeah, again, case by case and pretty nuanced. But I would always lean into your specific needs more than anything.
Yeah, TVL is a vanity metric. I would take that one to the bank.
Other questions? Over on this side, towards the front.
Thank you guys, appreciate this, opening up on what you guys should look for. So on that line, I wanted to understand a little bit more your thought process and your mindset on the projects that it's not a DeFi or a DEX, so it doesn't have really token right now, but more so focused on onboarding masses to the blockchain like Metaverse and stuff like that. So I wanted to understand your mindset and process, and if there's something you look for to invest, and what do you look for more in that aspect?
I guess, broadly as it relates to the onboarding pieces is sort of where do you live in the connective tissue between legacy tech and blockchain? For example, are you, launching on Avalanche, a different chain? Are you launching a subnet, an L2? Like, where does that hash out? But then in addition, what is your strategy for integrating with perhaps where the users are and onboarding these tens of millions of users? Like, that's convoluted. Are you managing private keys? Are you custodying assets? Are you going the regulated route? Are you fully online, browser-based, non-custodial? This is a DAO, and I'm moving to the Bahamas next week. I think there's a broad continuum, and just sort of where you map out in there is really, frankly, the starting point. And then from there, I'll let maybe some of these other guys comment.
I think this harkens back to our earlier question about finding the right investor. And you likely need to find an investor that has the same goals, that's looking for the same types of things. So if there's an investor who's specific to DeFi, it's probably not even worth a conversation. They're not looking at what you're working on in this case. But if one of their goals is to help grow users on this particular blockchain, or to bring new innovation here, then that's the right type of investor to be speaking to.
Thank you.
Next question.
Good day, pleasure. My question is, how important do you find experience, like past experience in building Web3 and cryptocurrency projects in this space in your investment R&D decision making, especially since majority of what I've seen of the investment have been going to people and orgs that are transitioning into the space. So how do you weigh the people that are kind of veterans of building but are looking for investment?
That's a good question. I don't know that we place more weight on it, but you do know that it's going to put you further ahead in certain areas, right? And that's an advantage. So for someone that's a previous founder or that's very experienced in crypto, you know that there's a lot of ground that's already been covered that you're not going to have to cover. And there's a lot of things in crypto that are hard to articulate unless you just kind of lived them and been through them, like community and sentiment and navigating that, and that can be really, really tricky. And so if you've been through that, I think there's a potentially a higher chance of success, just because this is kind of squared away. That being said, I mean, this whole industry is still relatively new. So you have lots and lots and lots and lots of new founders. And if you wrote those people off because they were new, it wouldn't make any sense. So me personally, I don't weight it differently. It's just kind of an expectation and what the work primarily might focus on will just be different.
I was just going to say, there's kind of been this pervading narrative in crypto that, crypto natives have this huge edge. They can raise capital super easily, yada, yada. I would say historically that's been relatively accurate, but it's definitely not the case moving forward. We need net new ideas. We need more talent, frankly, across the board, especially at all of our portfolio companies, but all these new teams being founded. There's new ideas to be generated, new, target markets. That being said, there is an element to what we're trying to do as investors, de-risk the investment. How well can this team execute on what it is that they're stating they aim to do? And a lot of execution boils down to technology execution. But in addition, kind of going back to the beginning in terms of my comment on preparation, if you study what's happened in crypto over the last several years, like in depth, and really go through maybe what's stumbled, other projects, or maybe what's helped others, and just generally market map, I think that's really going to put you on an advantageous footing to being, you're now a crypto native. What is a crypto native? Who knows? Go study it.
I generally look for credibility in the space more so than one of the others. So if you're creating a project that does, insurance in a Web3 manner, if you've been in the insurance industry, that's some credibility in the space. You don't necessarily need the Web3 aspect. Or if you've done other projects that are adjacent to it in Web3 but never really touched insurance, that's also some credibility there. So it's not binary. It's really just overall looking for some experience and credibility from there.
And from my perspective, just like founder perspective, Jamari, you described me perfectly. I think when I first talked to Mark and Dave, they were like shocked. Like, all right, this kid obviously has a couple core competencies he's super good at, like sales and infrastructure, but he's very green on the crypto stuff. And to your guys' credit, we spent a month just jamming out about things, and kind of you guys are showing me, like, yeah, here are some tokenomic models, here's what tokenomics is, whatever. And then to Brandon's credit, what he just said exactly played out. It's like I went to town for about 45 days of like, all right, well, what does it mean to be crypto native? What do these guys have that I don't? And it's really just like, how well do you understand the industry and kind of I focused on money flow, like where's the money actually come from and where does it go from one protocol to another? And once you understand kind of that plumbing, it's like, I see, all this is just kind of, like you can kind of get to a pretty deep understanding pretty rapidly if you kind of like get the right pieces in play. And then to that too, like while I was catching up, like it didn't lose heart because I was like, all right, well, I know I'm good at sales and I'm a good dev, so let's just like complete indexing on that while I catch up on the other stuff. And I think that's what helped create that very initial momentum.
Okay, I think we have time for one or two more questions towards the back there.
My question is, how much involvement should I expect from an investor on the business side? Can an investor potentially, or a set of investors, replace like business co-founder?
Meaning to find, like help you find a co-founder? Or do you mean like once you close the round, like how much can you expect the investor to help you out?
Yes, this is the second one.
I definitely very opinionated take on this. I think you can expect them to help you as much as you ask for it. Like, I mean, especially with like Framework, I was like, all right, these guys are super good. I'm super lucky to work with them and that they chose us. They have a big network. If you look at their portfolio, it's, you know, astoundingly S tier. It's like, all right, well, let's roll up my sleeves and let's go get these intros, you know? And then I think like, I don't know, we message a lot. You know, and it's definitely intentional. But if I'm not putting in any work to like ask investors questions or ask them for connections or think of ways I need help, like I expect investors not. I think it's a pleasant surprise when one of my investors messages me and is like, hey, by the way, look at this or whatever. You know, just because I don't know. I feel like I'm a very active founder too. So.
Thank you.
The investors, you know, have truly a vested interest in the success and want to help, but there are limitations. You know, you can't really expect them to replace a business function. They can't be your CFO, but they can provide information about how to do it and how other companies have done it, or make a connection for that. They can't be your business development, but they can make some introductions around it, things like that. So have reasonable expectations about their availability to help with the business as well.
I was just going to add, you know, execution is always internal, and investors are more of, you know, facilitating, advising, more strategic function. That's not to say we don't roll up our sleeves and get into the trenches, but you always want someone to own something on the team.
Okay, and one more question up here.
Can you guys talk a little bit about the differences between like the? Can you guys talk a little bit about the differences between the two types of fundraising, right? So GGP did one way, but fundraising on Avalaunch is a very different type of way. They're both fundraising, but they both are almost different formats. So what do those differences look like? What does it mean for maybe Framework being in one but not another? How does a team decide which one to go through, and what changes does the team need to make in order to do one versus another one?
I think we can just go down the line here and start with Framework.
I mean, I would actually defer to Mark on this, frankly, but you know, whatever it is to get involved in an ecosystem, which Avalanche is absolutely crucial towards, I think to back up, we are generally involved at the earliest round. And this is, again, before there's even a concept of token in the air. And so generally I would say it's more of a timing function more than anything. And it's just a part of the growth trajectory for GoGo Pool in this case, and you know, select other project teams, protocols, or applications who fit sort of this mold.
Yeah. So organizations like Framework and other VCs, and you know, Avalaunch to a certain extent, they generally come in much earlier, right? And are helping with the foundational, formational pieces of a company. What Avalaunch does specifically, you know, is we handle public sale of tokens. And so, you know, one of the things that's kind of always happened in crypto is some version of a public offering of the token, whether it's an ICO or an IEO or, you know, an IDO. You know, it's generally a good idea, we think, to give the user, the retail, the community, some kind of exposure to the opportunity. We think it, you know, builds a healthy community, and these are the people that, you know, are using the product day to day. These are kind of your users. So what we try and do at Avalaunch is just recognize that after you're done with this private fundraising, right, then you launch the project and you go out into the world, and you're going to have, you know, a big community and all these users, hopefully. And we think we can make a big case for involving those people in the capital raising than was traditionally happening before. We think it leads to a healthier community. So it's really just about kind of where you are in the fundraising, and Avalaunch deals with the public sale of the token, which comes, after all of this other stuff naturally.
And I would add that you can back into what's right for you by thinking through, like, you as a founder and your co-founders, like, what does your team actually want? Like, do you want to release a public good that just sits on the blockchain forever and it's like immutable? It's like Liquidity, right? Like, I think they took some funding, but I don't think they are going on the whole VC track, right? Or maybe they are now. But there's like a bunch of different ways, and I think it all starts with what you want. Like, if you want to just kind of get a wide distribution to your token, maybe skip the VC, and you're cool with not creating some 10x, 100x bet, but like something genuinely useful because you want to get it out there in the world more creatively. Then I think you just do a fair launch, right? Maybe do a little bit of crowdfunding or doing like an IDO, ICO type of thing. Probably not an ICO. And then for us, like, I very specifically, like my co-founder, we very specifically wanted to make a VC bet. We're here to make a rocket ship. We're here to create subnets. We're here to create the subnet economy. Like, we think this technology is genuinely cool. It can hit a super high scale with a very good distribution. And we think that's a future that can feasibly happen, but it takes a lot of components to it. One of that is VC funding and getting the right partners in on the cap table. So that's where we started just mentally, and that's how we backed into our let's do a VC round and kind of go for it.
I think that's a good place to end the conversation here. Thank you, everybody, for great questions. Thanks to Mark, Stephen, and Brandon on our panel. And just remember that funding is just one step along the journey. We're really genuinely interested in what you're creating, particularly what you're creating here at Avalanche Creates. So look forward to chatting with many of you about your ideas. Thanks, everyone.